What is happening, best ever listeners? Welcome to the Best Ever CRE Show. This is Matt Faircloth, and I am your host today. And this is my segment called Next Level CRE. And guys, I've got some help coming in. I used to run a podcast with this guy sometimes for another organization you might have heard of. So here with my co-host here for the Best Ever CRE Show is the Andrew Cushman. Andrew, how are you today, bud?
I'm doing really well. I'm enjoying life about as much as the people in pharmaceutical commercials.
I love, by the way, always ask Andrew how he's doing. Okay. Because when we were doing it for the other organization, there were certain things he couldn't say, which, by the way, Andrew, this is an unfiltered show. Okay.
I know.
This does not need to be a rated PG program. So say what you'd like here. Welcome to Best Ever.
Is this
before we get into it, guys?
The firm, like the organization?
What's it?
The other organization?
They know who we're saying, Andrew. They do, but we don't have to say it. They just do. I got the freaking logo over my head right now. How about that? How about that? Anyway, guys, if you want to come hang out with me and Andrew, have some laughs and those kinds of things, guess what? Good news for you. Andrew and I will be at Best Ever Con in February. You're going to be there, right? Did you say yes when they asked you?
I am going to be there. And it's tough to beat Salt Lake City for a location.
I know, you're a skier. We have other friends like freaking Burke, is like, no, I'm going to be in Hawaii and it's going to be cold in Salt Lake City. God bless him. But Andrew skis. And so anybody that skis will be at Best Ever. If you guys ski, come on out to Best Ever. If you don't, still come to Best Ever because it's going to be amazing. We're me and Andrew and lots of other folks, including the largest collective group of LPs that I've seen at a syndication or at a real estate operators conference. A lot of LPs come out. I've gotten many of investors that I've met at Best Ever Con. And more important than that, there is a lot of good, positive think tanking that happens at Best Ever in like just thought grouping and people that are doing things similarly or people that can show you new ways that they're running their businesses. There is nothing like the Best Ever Conference with regards to the quality of folks that are there. So if you want to come hang out with me and Andrew, go to besteverconference.com and type in the coupon code podcast, all capital letters, podcast 10 to get a 10% discount off of a Best Ever ticket. So, Andrew, you're going to be at Best Ever Con. Real quick, why are you coming? Why are you speaking? What are you excited about for being there?
Well, first, I want to see what kind of conference justifies a new verb called think tanking. I've never heard that before.
Hit it up.
But no, I've actually been several times before, and it's a great collection of operators, LPs, just people in the industry to connect with. I've been doing this 18 years now, and the longer I do it, the more and more I'm just convinced it comes down to the people, whether it's on all sides and all directions, the people running your asset day to day, the people you partner with, the people that help guarantee your loans, like whatever the role, it comes down to the people.
It is. And there's some great
things
people.
Like that's where you meet some of them.
And Best Ever Con's where you meet them, right? So come see us at Best Ever Con. Coupon code is podcast, all capital letters, 10, podcast 10, the number 10. So, Andrew, you have been and I know you listen to the Best Ever CRE show, so you're aware what you got yourself into getting into the fireside chats. For those that have not heard them yet, the way the fireside chat program works is the guest and I both write down a few open-ended, somewhat poignant, maybe even controversial questions, and just open-ended topics for the guest and I to get into. The curveball is that the guest and I do not know each other's questions. I've got a smattering of questions written down here. Andrew does as well. And we're both going to throw out our curveball open-ended questions and get into a nice little chat about these things. In that. So, Andrew, are you ready?
I'm about as confident as a 4-year-old in a Batman t-shirt.
I missed that one. You're confident as well?
I said I'm about as confident as a 4-year-old in a Batman t-shirt.
That's ready to jump off the couch on top of the Joker pillow laying on the ground.
Which means I may just crash, but we'll see.
You may just crash. You could break your elbow, right? Never know. Here we go. I'm going to give you the grace and the timing here. I will go first in that. Okay. My man, Kush, I've known you for years and years and years. Most people I know in this business have some sort of a operations partner, a Robin to their Batman, a Starsky to their Hutch, right? You, my friend, are one of the few operators I have met that does not have a, Frank Rosler to the Joe Fairless, or the name the duo that tends to happen, or even the trio that tends to happen sometimes in real estate investing, right? Why is that? Have you tried the partner model? Why don't you have it? And do you notice and do you think it works for others, but not you? Let's unpack that.
Yeah, I mean, I think the shorter answer is of like why you see a varied setup across the industry. It kind of has to do with where people came from.
Mm-hmm.
I was an engineer before I did this, and then
Me
I
too.
flipped houses myself, and then went into multifamily. And so I came from the mindset and world of I go do the thing. And so, and in the beginning, like most entrepreneurs, I wore every single hat. So find the deals, raise the money, close the deals, operate the deals. And one of the byproducts of doing that is I just built out operations as we did it. And part of it is, when we're raising money and taking people's hard-earned retirement account, funds, and, someone sold a business and now this is their chance to relax a little bit if they invest it well. I have family members in most of the deals. I just never got to the point where number one, I thought someone else would do it better. And number two, I can trust somebody else with my investors' money and my reputation. I think that's one of the unrecognized risks that whole kind of partnership model has inherent in it that people don't recognize. It's like, oh, hey, I'm great at marketing. I've got 64 billion followers on Instagram and X. So I'll raise money and you guys go find the deals and operate them. And we've known each other for an hour, but we both ordered the same thing at dinner. So we must be great partners and let's do this.
And
right?
we're both left-handed too. Did you know that? So that must
We
mean
both left. Oh
right.
yeah, we're both left-handed, and we've both never been to the moon. That is three things we have in common. Like this is a match made in heaven, and that worked in a sense great in a raging bull market where all you had to do was take massive action, buy anything, sit on it for 3 years, and look like a genius.
Mm-hmm.
But now that we're back to reality, where good deals are hard to get, operations are difficult. Unfortunately, some people that you and I both know and are friends with are finding out that they were good at raising money. They are people of integrity. They intended well, but they picked the wrong operating partner.
Yeah, man.
And now that operating partner's mistakes are taking them down with them because they didn't buy right. They didn't operate right. They used the wrong debt. I mean, there's a million different things. Anyone listening to you knows what those things are.
A lot of ways you can screw a deal up.
Oh, a whole lot. Yeah.
A
High number of ways. So with that, all those things combined is why we just decided we are going to be all of it. Like we are one shop. We are, because I look as if I'm taking the money, then I need to be responsible for what happens to that money and in control of how it's being treated, how it's being invested, how those properties are being run. And then, so we did that. And then we kind of developed our like hybrid asset/property management model out of that. But yeah, you're right. We've never had an outside GP.
That is interesting. And it's one of the few entities that I've heard. You explained it perfectly in that, and I've seen a lot of folks that hitch their wagons either to the right folks or the wrong folks, right?
It can work. It can. Yeah.
Joe Fairless was like, I asked, he was given a talk a while ago about in choosing the right partner. And he's like, never partner with someone who hasn't done what you're asking them to do in your company, that they haven't done it somewhere else. Meaning like.
That's a good distinction.
It is. Yeah. Because it's like, whatever screwing up they're going to do, whatever guardrails and learning curve they got to deal with, they're not going to do it on your business. They're going to do it over there, wherever they did it over there. Then they're going to get good at it. Then they're going to come on over to your company.
Yeah, well, it's like if you graduate pilot school with your best friend, you say, hey, let's both go pilot a plane. Yeah. I'm not going to get on that flight.
Yeah. Because he's learning. Still learning. You want him to go fly for...
Both people are learning.
Yeah. Go fly for United Airlines for 10 years, then come fly my plane, Right. So I interviewed a guy yesterday that now works at Reed's company, and he's in a fellow mastermind of mine and yours. That he's one of our mastermind buddies. And his CIO and investment officer that finds their deals used to work for Cardone. right?
Ah,
You want to talk about somebody that brings that kind of experience to the table. Like that was cool. And you could tell talking to the guy that this was certainly not his first, second, third, fourth, fifth, 10th rodeo. He was, knew all the parameters. I had to keep talking. I had to keep telling him to de-jargon what he was talking about because he kept like jargonifying it. And I'm like, whoa, whoa,
uh,
whoa, 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 bring it down. Layman's term and all that. So that's like somebody who's been around the block a lot. You don't want somebody who's learning on your dime. Um, Going back to it, if you were able to create a partner for yourself, like if you had to take a partner, what would this partner do in your company? Like if you're just forced to keep going, to keep growing, ye must taketh a partner. Well, what do they do?
um, if I absolutely had to, I would probably partner with somebody on the capital raising side
Hmm.
because the operation side is where things can go bad. If someone, because here's how I look at it. If someone comes to me and says, hey, I want to partner with you, I can raise another $50 million. And I'm like,
Yeah.
cool. And they fail. Oh, well, no harm done, right? Like we just maybe didn't grow as much as we thought. On
Yeah.
the flip side, if I bring someone in who's like, hey, I'll go do 5 amazing deals. You go raise $50 million. I raise the $50 million and then they screw those deals
And they
up.
wrap it around a tree. Yeah.
That is an entirely different situation. So
Yeah.
if I was going to partner with somebody, it would be a very proven capital raiser who also raises
Yeah.
capital in the same way we do, which tends to be a little bit different. So
Yeah. So when I look at partnerships, like I'm a good capital raiser guy, right? I mean,
you
if
are.
you and I had met coming out of grade school, we would have been good partners because you're a good engineer operator. I say this with love, but kind of like a nerd, right?
Oh yeah, no,
Like, and you're
I'm a
like,
wannabe. Everyone, you see the surfboards and all this stuff in the background. I'm a want to be athlete trapped in a nerd's body, like
you
hands down.
are,
That's just yeah.
yeah, you got a collar on your shirt right now and it's Friday, like no dress down
I'm
Friday
like,
and
hey,
Christmas stuff.
I'm talking to Matt. I got to throw something
Yeah.
on. This is what I
I
was
bet you
wearing in
10
the
cents.
airport, man.
I bet you that shirt's tucked in.
It is not. I am barefoot too, though. I am
Are you
barefoot.
really? Boy, see,
Oh yeah.
you are like a wannabe cool guy. Look at you. Okay, so I think that there are people that partner up because they bring in energy to their business that's not something they bring themselves, right? I'm a good I'm a good hype guy. I get people excited. I can explain
Mm-hmm.
complex things in a simple fashion. I can do the YouTube shtick and the podcast and all that stuff. So I'm good at drawing attention to a thing, right? And once I've got the attention, I'm good at explaining what that thing is, be it a hotel deal, multifamily deal, whatever, right? My problem is I'm not as good on the books and on operations and that kind of thing. So I have to bring either teams or partners to me to do those things, right? So in getting around the partnership model, how were you able to hire in around yourself the energy that you needed? You didn't want to bring partners in. You want to like bring people in that are not great at what you're great at and vice versa, right? How'd you figure all that out through an employee model versus through partners?
Yeah, and actually, it's funny. As you were talking, I was listening, but I was also thinking and saying,
I
I
do that
I
too.
want to clarify and and not because you're supposed to like really listen and not think about what you're going to say, but on a podcast, it's a little tough because then it's like just goes silent,
No,
right?
nobody
Um,
does that. Nobody does that. First of all, that's bullshit. Nobody really just listens the whole time. Everybody thinks of what they're going to say next. Like don't shit. Everybody does that. They don't think, oh,
I have not developed that superpower yet either.
nobody has it. Maybe a
So
monk. Like that's it.
just like you gave a really good distinction from Joe earlier. He partnered with Frank and like Frank good all all that kind of stuff. I did the first deal that we did almost killed us. Right? I mean, this
Hmm.
was in multifamily deal, meaning we had to raise like 1.2, and it took 6 months. Extended closing like 3 times. And the way we finished it is actually got the seller to just do a carry for a couple of years until I could get it stabilized and get refinanced, and it
Jeez.
worked out great. But after that, I was like, "Holy crap, this is hard!" And then so what I did is the guy that I learned the business from, I said, "Hey, let's partner together on this next deal." But we're both operate like we are both everything. We're both raising the money. We're both operating it together. And so we did that. And then a couple of years later, well, another deal later, you guys, David, Pat, and Tim, they came to me and they're like,
Hmm.
hey, we love investing with you as LPs, but you're a good operator. We know a lot more wealthy people than you do. Let's partner together and build this business. And
Hmm.
so I wanted to clarify, and that is, our group is still together to this day, 13 years later. So the slight nuance there is it's not an outside partnership. It is, hey, like you said, I'm good at this. You're better at this. Let's combine forces and then go build this business. So
Hmm.
I did have partners. I want to clarify. It's not just Andrew out here building this thing awesome by myself. That's definitely not the case. I did have partners, but it was not kind of the more standard what you see, kind of like the outside partner model of, hey, I'm just going to do this and then you go do operations, or hey, like some people that will have a different partner on every deal,
Yeah.
which has some
Well, you
risk
have with
to it.
those guys more of a JV, right?
Oh no, we the four of us we are members of one entity, and then that entity does everything.
Yeah. But you're doing 90% of the material lifting work, right? Like they're
Yes.
raising the capital, you leveraging their networks and being able to do larger deals they'd be able to do on their own with a lot of their money and with a few of their buddies' monies alongside it, right? That's a unique, that's almost like, I get it's not this, but that'd be like joint venturing with a private equity firm, right? Where or like a family office would show up and say, okay, Kush, we're going to give you a $5 million line and say, go find us a deal that meets this buy box and we will put this up to 5 million into your deal with you, right? That's almost what that is. Cause I'm sure there's some carve outs and some recourse that God forbid things don't go the right way. They could take you out back and shoot you like old Yeller, right? But for the most part, you're going to keep driving the bus, right?
Yes.
So that's more, to me, that's like more of a JV than it is like an active partnership where they've got like a thing that they're doing and then you've got a thing you're doing. So, but I like the way you
Yeah,
explained
you're
it.
right. Yep.
Yeah.
Yeah.
I like the way you explained it in that, like, hey, listen, this is my brand. This is my, this is my name and everything like that and my company. You got to be careful on who you bring in because you're latched to it. And I've had plenty of friends in this industry who have had bad things happen. They ended up like things didn't work out, and it's like their brand suffers from it.
And that's why we structured it. One of the reasons we structured it the way we did is if something goes bad, all four of us get hit by it.
Oh
It's
yeah,
not like, oh, well, one partner screwed up. No, sorry for him. Or,
yeah.
oh, well, that's like all four of us are in the same boat,
Hmm.
float or sink. So, yeah.
So okay, so we've talked that one out. Thank you for your insight on that. Are you ready to spin the roulette wheel and head over to the next topic in the fireside chat? Would you like to toss one of your topics out there?
Yeah, this one,
Throw a log on the
this one,
fireside chat. Here you go. Throw your log out there. Go.
it may be one of those chemical logs that gets colorful.
Hold your breath, everybody.
So it's no, it's not that. A while back, I know you're familiar with it, and most people listening are probably familiar. Like the whole 10x is easier than 2x, right? Like that was
Oh yeah,
all
yeah.
the rage for a long time. And there's some very
It's a fucking macho
definite.
ass book. That's a macho. It works sometimes, but yeah, keep going.
Well, that's what I was
I'm
going to say.
in. What?
Yeah, there's some absolute truths to that, right? I'll just quick example. I would 100-unit multifamily property is way easier than a 10-unit, like
Correct.
or a 20-unit, right? So hands down, yes. Now, on top of that, there is like Ben Hardy's new book, The Science of Scaling, right? Which
Mhm.
is and I've heard him speak on it twice, and it's basically like accelerate that even more, right?
Yeah.
What I want to know is, what do you think are the mechanics of successfully doing that without imploding? Because when you look around the multifamily industry today,
Mhm.
most of the dead bodies are the ones that hyper scaled or in like 2019, 2020,
Oh yeah.
21, 22, and that didn't end well. So
Yeah.
how do you balance scaling versus operational excellence in execution?
It's okay. Good. And I mean, I said it's macho ass book because there's part of that title, and it's got to do with even the Cardone book about the 10x concept. But I know we're talking about Ben Hardy and Dan Sullivan. Dan Sullivan was the inspirer of that book through the strategic coach model and all that. And there's science too. The 10x is better than 2x. And I've read the book and all that, and I'm about halfway through Science of Scaling right now as well. So I get it, but a lot of people that want to skim those things or get just the nuggets out of the Hormozy concept about $100 million deals and that kind of thing, they can hear that it's just sexier to go big. And that's the part they wrote down. They missed the rest of the notes on 10x is better than 2x, which is that in essence, it's easier to architect a system to do a 10x scale than it is to architect a system that's going to go smaller. The returns are better and the work is around the same. That's kind of what they're getting at, and to sum it all up and all those concepts. The problem there is that I don't think what Hormozy or Ben Hardy or Dan Sullivan are trying to say is that you should just go out there and buy a big apartment building and figure it out, right? Or go buy 1,000 big apartment buildings and figure it out, because that's a great way to get your ass handed to you, right? Is to go do lots of, to not have the capacity, but to be dumb enough to think that you could make it work on your own, to go and buy a couple thousand units or with the team that you got or whatever it is. Right. And that's the problem with real estate, is that you can go and put deals like that together. Or back in the day, you could, when equity was easier and when debt was easier and all that, you could go and put deals like that together. And it was very easy to screw it up because they didn't read the rest of the book that was about like build the systems in place, build the systems, the mechanisms, all the things. Like they use the analogy of going to the moon, right? Well, in the Science of Scaling, that was one of the analogies in the book, the whole concept of going to the moon. I mean, it'd be like trying to go to the moon with a slingshot, and you can get there, but you can't get home, right? Like the whole Apollo 13, because they never bothered inventing the science to for the rocket fuel systems or the parachutes or whatever to get back to Earth. But in multifamily, you can get going without having the operations and systems in place to know what to do after you acquire those assets. And that's why I think that concept is sexy and sure sells lots of books. And if you read the whole thing from cover to cover, it'll give you the playbook. But I think a lot of people don't. They just see the cover of the book. Like, cool, that's my authorization to go out there and try and buy 1,000 units. But what are your thoughts?
Well, so, it's funny, the multifamily industry in particular, it's kind of interesting in that, yes, you can quickly end up with a positive $10 million net worth, but you can just as easily end up not at zero, but with a negative $10 million net worth. Yeah. And so, I mean, there's real and serious risks there.
Sure.
And do you see it as more of like one of the concepts that I love, if I understood it right, is just kind of the like, hey, if I was gonna scale massively in 10x in like not linearly, like that's one of the concepts. It's not like, well, I did 500 last year, so I'm gonna do 600 this year, like that, and then 700 the next. That's linear. Whereas the Science of Scaling is more like, well, I did 500, now I'm gonna do 5,000. This is more of an exponential curve. Do you, in the thought process of saying, well, what would that look like? There can be a lot of value in that, right? It can help you think of, well, if I was going to do that, well, I'd have to stop doing this and stop doing this. Yeah. And I would have to start doing this. I'd have to go partner with this person, and a lot of value and true scaling ability can come out of that. So do you see it as more of a legitimate roadmap to Xing in a short period of time, or more of a thought process? You're gonna shoot for the, what's the expression? Shoot for the stars and land on the moon, or something like that, right? Like, like, okay, maybe I'm going for 10x, but hey, if I land at 4x, that's great. Yeah. Do you see it more like that, or kind of like, what's the? That's like, so when it just comes to scaling in general, like, what is the pros versus the cons?
Well, there's well, a lot. That's something. That last part you just said, I had to answer, and then you just threw like the last part, like, ooh, is it bad to scale too big? You just let me respond to a few different things, right? They're reading into just should I scale, right? Or should I go bigger? That's all ego-based thinking, right? There's something
No.
to the law of attraction, mind manifestation. There's a book called The Magic of Thinking Big, which is a phenomenal book. If you guys want to, best several listeners, go check out that book. It's a good mindset book. And it's really about like what really happens to your life if you start thinking a little bit bigger than you are now, right? I'm a big manifestation, law of attraction, divine energy, all that stuff, big into all those things. And there is a lot to that. But I'm not saying that you should just go blindly go and make offers on 100, 200 unit apartment buildings. I think that really the difference is in like that ego activity of like, I'm just going to go big and figure it out, because there is some of that in all the things and the 10x psychology and the and Hormozy stuff or whatever. There's a lot of bro going on in that world about like, let me just go do big and get my Lamborghini. I got it. Okay. Now let's get real. And if you're what those books are really trying to tell you, when you actually read the book and not just read the covers of the book, you actually read the entire book and not just listen to a podcast that Hormozy's on. But if you read everything the man has to say, there's a lot to building a business, a system, a network that, skips over a few of the ropes that are not necessary, as you were saying, right? Like maybe I don't need to architect the systems to do a 2x, 3x scale. Maybe I just need to architect the systems, capital S systems, to do a 10x scale. And I think that's what a lot of people miss, is that they allow books like that and that psychology of swinging for the fences to speak to their ego, right? Versus let me sit down and think about what my business needs to look. If I had a 10x business, what would it look like? Let me interview a few people that have 10x businesses and see what they had to do to get there. And how can I emulate what they have now in their business systems, processes? Who gives a shit what kind of car they drive? Let's talk about what they did, what they implemented to hold down and run successfully the 10x size business that I want, right? I think that's the difference. I think that's what a lot of people don't do. And that's how the house of cards falls apart, is because those that you and I are talking about that we've seen scale quickly and then fall quickly did not have any of that infrastructure architecture built. Like they didn't have that. Half the people they partner with to scale like that, like took their acquisition fee and moved on, or airport retired at 32 years old, started living the van life, right? On their acquisition fees. And it's like, wait a minute, we're supposed to build this thing. No, you can't just disappear after we do a few closings. Now the work begins once we close. People don't realize that's the side of multifamily that really matters. It's got little to do with closing the deal. It's got a little to do with once you do what you do with it once you own it.
Yeah, I think that's well said. When I think back again, we won't list names on the podcast, but
No.
When I think back on a lot of the dead bodies or zombies, meaning going to be dead soon. I think that's actually really is a part. Yeah, a lot of it seems ego driven. I'm going to get to X units, and like I can raise. I got this guy who can raise unlimited capital. I'm going to go do unlimited deals, and
who's going to run the deals once you have them? That's fine. We'll figure it out. We'll just hand that over to the property manager.
Nobody stopped to figure that piece out, and then now the problem is you always have to run them well, but now today it is. Operations today is harder than it felt even in 2011 and 12. Like it is very challenging right now.
And it changes.
Not impossible, but challenging. Yeah.
No, it's, and the problem is operations isn't sexy, right? In the real estate investing business, what's sexy is closing. What's sexy is how much money you raise, that kind of thing. But that's got nothing to do with real profitability in real estate. What has all the profit is in operations. Right. That's why guys that I look up to, guys like Brian Burke, because he's like super dry, somewhat of a curmudgeon and stuff like that. But I'm like, he's
somewhat.
What's that?
Somewhat of a
somewhat. Yeah, I know. He's like all negative and stuff like that. Rah, rah, rah. I remember you and I had him on that other podcast and stuff like that, and we were both kind of throwing rocks at him and like trying to trip him up and everything like that. But
Brian's a good guy. It's fun to agitate him. Well.
He's a great guy, and that's what makes him a great operator, is because he's somewhat pessimistic, but he's super granular, super detailed and stuff like that. And he's good at the right things in the multifamily world. And that, which is bottom line, ops, scanning through a P&L, finding the nickels and dimes that add up to dollars and more in a profit and loss statement. That's what's going to make you money in real estate investing, but it doesn't do well on an Instagram feed.
No, yeah, and because of that, it seems like, especially the last few years, most operators that got a deal were kind of like the dog that caught the car, and it's like, oh crap, now what? It's like, I got to do something with this.
I can't just take my acquisition fee and move on. I actually have to do something.
Yeah, it's a real business.
Great question, 10X in multifamily. Have we talked that one out, ready to move on?
I think we have.
Okay, cool.
Yeah. I liked what you had to say. That was good.
If I were to pull out my magic wand and poof, take away the existence of multifamily real estate in the world, and you had to keep your business going, you couldn't go and pull out and become a professional mountain climber, skier, like I know you would want to do, right? If you had to stay in the syndication world, what asset class would you have to pick? Aside, because you've been very disciplined, you're mainly multifamily. I know you've done some resi deals and some housing, and you're doing some construction stuff and everything like that.
I looked into it, never did it.
What's that? No, but you've done
never did it.
Well, I mean, flips, like that kind.
Oh yeah, before we got into multifamily, yes.
Right,
I'm sorry,
right. Yeah. But I've done most of 99.99% of the work that I know of has been in some sort of a residential solution, right? That you've done. What if I took residential real estate away altogether, and I'm counting mobile home parks in there, because that's too easy of an answer, because it's kind of sort of an apartment building with a different strike. So I knew that was going to be your answer.
Horizontal apartment building.
What's that?
It's a horizontal apartment building.
Horizontal apartment building. All right. So I'm taking that away too. What would your asset class be? Why? And how would you reframe what you're doing now to fit that asset class?
I like that one, Matt. And that's actually a question I ask myself occasionally. Like,
ooh.
I mean, I don't know what it would be.
You have shiny object syndrome like the rest of us, huh?
No. Let me give you the framing.
Uh-huh.
I can't think of what would make multifamily irrelevant or uninvestable, because it's a core need. I mean, like, it's just, I can't, but I never want to assume too much. And I'm always asking, where could my assumptions be wrong, or what could I be missing? And so I have asked the question, what if in some scenario that I can't quite think of, multifamily is just uninvestable? Yeah. What would be the other thing? And you know me well. I want to see if you can take it. I won't change my answer, because it's do you have a guess?
Yes, I do.
What is it?
I probably would pin you as a self-storage guy, because of the amount of analytics required. Like, there's so much algebra, algorithms, if this then that's, equations, that I think that you would be able to get in there, and that engineering brain of yours would be able to get in there and figure out the algorithms with the geography, and there's not, you would know the equation down to the point of, like, there's not a self-storage center, and there's this many rooftops in this, district or whatever. You'd know the hot spots and everything like that. So I think you could figure that space out because of the amount of logic and math that there is in that world. So that's why I think you're a self-storage guy.
That's a good guess. That one was on the short list, but what I landed on, number one, would be laundromats.
What?
Yeah, because a handful of reasons.
My mafioso wife wants to be in laundromats. My very Italian Pazan wife wants to do it, only because she thinks there's a lot of cash. Because it's kind of
tell her.
Because I'll be like the guy from Goodfellas.
She's a smart lady, in my opinion.
What's that?
She's a smart lady, in my opinion.
She is.
I mean, she picked you, right? So
she sure did. Yeah, right. Why? Why laundromats?
Well, one, AI will never take away the need to wear clothes, especially in warm environments. You're going to need to launder those eventually. But the AI might, we may have AI washing machines that just, you chuck it in there and it does everything, but the clothes are still going to need to be washed. Yeah. That's number one. I see it as somewhat of a moat against the army of AI robots.
Good point.
But really, the biggest thing is we're both in GoBundance. I know through GoBundance several operators who have scaled significantly laundromat businesses and shared with me their numbers. And Matt, it would blow your mind how lucrative those businesses are. Now, you're not going to do like you do with multifamily, where, in 5 years, you're getting an equity multiple of 2 or
Hmm.
something like that. But if you're looking for cash flow, laundromats are, when done right, are amazing.
How would you do it differently if it's not buy the business, parachute somebody in, and then walk away? Because anybody I've talked to that wants to buy businesses, including other guys in GoBundance, that's been their equation. And also, like I said, no money down.
What I would do is, as actually a local guy doing it here in Southern California. He's the guy I spent the most time with. Again, just because I'm fascinated by
These buying laundromats.
what other successful people are doing. And again, not surprisingly, smart guy. He is not buying these things and then just spending his time on the beach. He is, if I was going to do it, I would go shadow him, work for free for 3-6 months, something like that. Then I, maybe even hire him as a coach or mentor, whatever. I'd go buy one. I would go operate it so that I know all the little details, the ins and outs, and then start accumulating more so that I can hire people to do those pieces for me. But because I know the roles, I can hold them accountable to what the role, what good performance looks like.
Yep.
Most laundromats are still held by mom and pop operators. They've had them 30, 40 years. They cash flow kind of on their own. So they haven't done the business systems. They're not exposed to GoBundance. They're not at Best Ever. They're not reading the books that, you and I read. And so there's a lot of opportunity there to come in and just, really run it as a business. And what's amazing is, like in the multifamily world, we have rent, but then we have other income, trash fees, amenity fees, and that can be quite significant. The same thing applies in laundromats. Again, just the guy I've been talking, he went and he bought his own soap dispensing machines. He created, he now owns all his own vending machines, his own
But
cash.
how many roofs does he have though? Like how many to get to that point where you can go vertically integrated and kind of own the entire freight line, right? How many centers does he have roughly?
I don't know the answer to that off the top of my head. It's at this point, I would say moderately substantial. It's all, my understanding is it's all right here in Southern California. So it's not like thousands of units, right? We're talking like a handful of locations.
Yeah.
And he's building out the systems so that he has the entire thing from beginning to end. And then it becomes, something that can be duplicatable, if that's the right word.
I think
And then you can you collect enough of these little random and then turn it into a real business and a real company.
Yeah.
Then you can either franchise it or sell it at a higher multiple to a bigger operator. So you're cash flowing a ton while you do it. And then there is the potential for an equity multiple on the back end when you roll up and exit. And I've talked with a couple of guys doing it, and it's like, wow, that's pretty amazing. I mean, I would not want to do it because, it's kind of, Keith Cunningham in The Road Less Stupid talks about, starting over again. You remember those like in the 80s, those like metal merry-go-round things at the playground where like 4 kids get on it and it's like a horizontal wheel, and you try to spin it around faster and faster and faster.
Friggin' death trap, right? Absolutely.
Yeah, they're death trap. And then like the one kid flies off and takes out 3 kids standing nearby.
Right.
So
a kid gets stuck underneath it. We had that happen at a playground. We still have one of those at a playground by me. And that a kid kind of like get wedged underneath the thing and like get rubbed into the gravel. Not the gravel, but like it was like mulch underneath it. And he kind of got pinned and whatever. It's all good. He's okay. He'll be all right. He'll be all right.
We'll still wears a helmet.
It's good. But yeah, okay. So I know the spinny spin that you're talking about. Keep going.
Yeah, right. Just think how much more effort does it take to get that going from a dead standstill versus once it's spinning, you just, to get it going, you're pushing as hard as you can, your feet are slipping on the mulch. Once it's spinning, you're just standing there whacking the bar as it comes by, right? Way less energy, way less effort. So I would not choose willingly to go do that. But if I had to, the context to your question, as of now, that is my answer. I would go into laundromats, because there's a potential big exit on the back end. I know people I can learn it from. The same thing I did in multifamily. I want to do multifamily. All right, go find the first thing I did was find a guy who knew it and learn from him. And that business cash flows right out of the gate. So my businesses, my cash flow needs are taken care of while I build something bigger for down the road.
You just said a few things to highlight, right? I've heard this is maybe a good reason why multifamily investing is good, in that if you serve the masses, meaning like if you create a business that serves everyone, right, or as many people as you can, you will eat with the classes, meaning like you'll make like a reasonable living or a really good living for yourself, right? And laundromats are another one of those things where, as you said, it's somewhat tech and AI proof, and I don't think that we'll ever phase our way out of it. Although in buying an apartment building, one of the first things that you look at if you're buying like a 70s or 80s vintage C-class, immediately you're like, okay, how do I drop a washer dryer into these apartments? Because any resident is going to want to not have to go to the laundromat. But the laundromats will always be there. People will always not be able to afford to live in a unit that has a washer dryer in it. That is an amenity, it's a necessity for some people, that are bougie, but for a lot of people, it is an amenity that people either can't afford or don't think that they need. So they're going to need to go to laundromats. So I agree. It's not going to win anytime soon. Also, some of the guys that I know in GoBundance as well, local to me here in Pennsylvania. It's funny, you and I are a world across from each other, but we both know guys that own laundromats in GoBundance. The guy that I know, something like 40% of his business, 40% is in non-on-site laundry, meaning like they have washing.
Yeah, that's a whole nother opportunity.
A whole thing. So when my wife and I finished, you were talking about, I'll talk bougie with you. When my wife and we finished our basement in our house, and that means our washer dryer was out of commission for a while. We signed up for this service that delivers your laundry to and from your doorstep in the same day, man. So you put your dirties out front in these big bags, and they come pick them up. And it's folded in little twines and stuff like that. It's all perfect. And we figured out that a local laundromat was running that type of a pickup and drop off service, right? So that's what this guy was doing. Not the guy in GoBundance, a different operator, whatever we were hiring, but the guy in GoBundance was also doing like a whole thing for people that could do their own laundry, but for one reason or another didn't have the time to do it. And so they were using all their machines to wash other people's clothes too. Brilliant. There's a lot of different ways to make a laundromat make money. There's even optimization plays. You don't have to go collecting quarters. It's not always a cash business anymore. A lot of laundromats are run on credit cards now, and everything. So there's modernizations that you can do. And one thing to underscore that you said too, a lot of them, I believe, are still mom and pop owned. I don't think mom and pop own many multifamilies anymore, partly because of the amount of work that it takes to run a multifamily. A lot of them just aged out and wised up and said, wait, and the market going up has helped them out to say, okay, you have a really profitable exit. You might as well just sell, right? I used to do deals with mom and pop multifamily owners years ago. I haven't seen them on the market in a long time. But as you said, it's something that's a lot less work to run a laundromat. So there probably is a lot of that space there too. A lot of those owners in that world. So I agree. So other thoughts on laundromats? Love your answer.
Yeah, it's a boring business, but I think there's opportunity there. You got to do it right.
You got to do it right. Okay. Do you have I got another one for you, and I got a quickie curveball personal, lifestyle question for you. And unless you got another one for me.
I do have another one.
Go. Another log on the fire. Right. Another log on the fire.
So,
bring it.
Well, I don't know if this. I don't think this will be controversial, but I think it's important.
I got a controversial one, but go ahead.
All right, cool. Then make sure we save time. I want to hear this. Hold on.
Before we get to Andrew's big question, let's take a quick break from our sponsors. And we're back. Okay, Kush, go ahead and give me your curveball. Maybe not controversial, but good question. What do you got? Log on the fire. Bring it.
So we all thought the deal dam was going to break in 2024, and we were all going to be out there doing these awesome deals. That didn't happen.
Survive.
Then we're like, for sure in 2025, there'll be all these great deals.
Mm-hmm.
Now we're like, it definitely in 2026.
Any minute
now. And the reason for one of the reasons, there's a lot. One of the main reasons for the deals not happening is the bank's extraordinarily willingness to, as we like to call it, extend and pretend.
Mm-hmm.
Meaning, oh, this loan is due. Let's give it another year, or let's give it another 2 years. And many owners and operators of all stripes just fighting tooth and nail, like, we're not going to recognize this loss and just keep it going and hope the market saves us. How does this end?
Yeah, geez. There is the optimistic view that this thing ends by rates eventually creeping their way back down. And that was what the survive till 2025 mantra was all about. In that the Fed raising rates, which indirectly pushed up the 10-year treasury, which indirectly pushed up borrowing rates across the board. I say indirectly because the Fed does not directly control the 10-year treasury, or, it's all economic systems and factors and KPIs and those kinds of things that all push things up. So not to get into economic lessons, right? And that's why when the Fed dropped the rate a quarter point, pretty much borrowing rates didn't even move. And so the thought process is that as the Fed starts to drop rates, eventually it trickles its way over to Treasury, and that starts dropping things like SOFR, starts dropping things like the 10-year Treasury, so that borrowing rates go down and that we can refinance our way back to freedom, and that debt rates come back down, which pushes values back up, right? And that we all blip our way back. That's what some would say. Before I go further and explain to you what I really think is going to happen, do you think that that is viable, probable, what I just described?
I like the word you used. I try to think probabilistically and
Yeah.
never be married to a specific outcome. I think there is a reasonable probability that a combination of rising rents and therefore NOI, and I'm going to say maybe stable interest rates,
Mm-hmm.
does provide a acceptable exit for many of
Mm-hmm.
these.
Mm-hmm.
Also think there's a reasonable chance that it might be a small percentage of them.
Mm-hmm. Yeah. So to go with that small percentage, I agree with you. And I think that there may be a gap that gets closed for some deals, right? But I've already heard of people that are out there selling multifamily assets. As I was telling you offline, that I interviewed somebody here on this program that had a lot of deals that ended up not working out, right? For one reason or another. And there's a lot of people that you and I know that have things that are selling. We at DeRosa Group have things that are selling right now that are going to sell for markedly less than what our underwriting said that they would. And we're just, the deals are tapped, right? I mean, at the end of the day, you can't take blood from a stone. And so the cash has been utilized to buy rate caps, to buy extensions and that kind of thing. And that cash was supposed to get used for renovating units, and you can't do that anymore. So now you either got to sell or do a capital call. And I can tell you, investors are very, and I think that this is probably there's all the factors, but the biggest factor is investor sentiment.
Yeah.
And I think that investor sentiment, a lot of LPs have probably just written off the cash and just said, like, you know what, if you're going to give me a 40% haircut, fine. I'm mad about it, and I'm going to stomp my feet and curse your name and all that kind of thing, but I'm going to move on to the next thing. And God forbid you have deals that are selling that for people like you and I know, that are going to go to 0% principal return. I am sorry to hear that that's going to happen to some of these folks and some of these LPs and GPs. But I think that is what it is. I think that the probability of investor cash coming in to keep these deals going is very far and few between. And yes, there's rescue capital. That's like fingers crossed money. Yes, there's pref equity. Yeah, that's just shark money is all pref equity is. So I think, yeah.
Rescue capital with air quotes, and then probably the only thing that's worse is the pref equity.
Yeah.
The third party pref equity.
Yeah. And the third worse than that is literally just calling Tony Soprano himself and having him break your legs if you don't give him the money back, right? So I think that because the time is running out, and the extend and pretend thing is great, but these deals are just running out of cash that I've seen, folks that I've talked to, and some the operators are having to get real. The GPs aren't able to smoke and mirror the deal. It's like, listen, this deal just needs a cash injection. My investors aren't interested. I can't go bridge to bridge, so it's going to need to sell. So I think that the short answer is you're going to see a lot more sales that are realistic, that are maybe a haircut for equity, but I think a lot of these deals are going to get shaken out. They're not going to get refinanced or anything like that. I think that these deals and they're getting worked out now. We've seen bidding a deal today that we're bidding it at debt. And that's what the broker's whisper was what the seller's debt is, because that's what NOI works out to be. That's what the value is. As I said, we've got some stuff that's selling for less than we wanted to sell it for, and so do many, many others that are out there. So I think that the shakeout is happening now. I don't think it's blood in the streets, and I don't think it will be. And the reason why it won't be blood in the streets is because a lot of folks don't have the debt positions that are causing all this strain on the market, these bridge debt pieces that have these floating rate debts and rate caps and all that mess, right? All that is there in a smaller percentage of the market. So that's why not everybody use that kind of debt. You're going to see some shakeout, but it's not going to be a mass market correction. It's going to be for those that are plugged in and for those that are willing to roll their sleeves up and do a big cash injection and turn a deal around. There's opportunities to be had, but understand, guys, I don't think that any of the deals that are out there that are going to get bought anytime soon are going to be cherries. These are going to be deals that seller did not have the operating cash they needed to run the property, and the deal needs to get turned around. It needs to get the, big capex, big turnarounds, and dealing with today's economy. And I have just one more thing to throw out there. You said rent increases are going to eventually cover the sins. I don't see rent increases coming in to save the day. I debated John Chang on this program here about it. I don't think rent increases, he's always the optimist, but he's thinking that's because he's the lead economist for Marcus and Millichap, right? And super.
I think you have to be an optimist to work for them. That's just how it goes.
Yeah, of course. But like he says it, and he's the things he says make a lot of sense. But I don't think that rent growth is going to get us out of the multifamily mire that we're in right now. I don't think so. So I think the pig has to work through the python, to answer your question, that the pain has to work its way out. I think rates are going to stay high. Sorry, best ever listeners. It's going to cost you 5.5%, 6% to borrow money for a multifamily for the foreseeable future. That's what I think. I think we need to plan for that. Your response to my monologue.
So, there was a couple, you mentioned, so rent growth. Yeah, I would say, rent growth expectations, you very much have to vary that by market.
And by asset class. A and B are seeing rent growth. C is stagnant. It is not seeing any rent growth at all. There are two Americas out there,
There are. And I think you're spot on, especially if you're talking C class. You may have to wait a little bit longer, but that's actually the normal cycle. In a bull market, C is kind of the last one to get pulled up, and then and so you have that longer period of whenever the bull market starts, C is probably the last to benefit, but then also on the way down, it gets hit first and it gets hit the hardest, and that's why one of the reasons why those typically trade at much higher cap rates, because there's more volatility, there's more risk, and that when you're talking about, hey, B and A will probably do okay, but C might keep getting worse, that's natural. That's just cap rates expanding back out to their normal spread. So it's just reversion to the mean. So yeah, I do agree with you. I see if, markets that have positive population growth, from net migration and don't have oversupply, I think 2026 could see low to moderate rent growth. Same thing in 2027, let's say between 2% and 3%. Beyond that, it's anybody's guess. And again, I'm talking, B and A. I don't operate in the C class anymore. So,
what do you think? So, that's your response to the rent growth question. Give me your thought on. I mean, I told you, I think that the shit is shaking out right now. What do you think? Where do you think that we're going? I don't think there's any survive till 2026 or whatever. I also think there's blood in the streets. I think that the good deals and just the deals that are out there, they got kicked the can down the road. People are just going, okay, let's just control alt delete and move on. That's what I'm starting to see. What do you think is happening?
Yeah, I'm with you on the interest rates. I think the most probable path for interest rates is possibly a slight downward bias in the near term with
Mhm.
an upward bias in the longer term. That's
All
where
right.
that's where I land on interest rates. In terms of all the zombie deals out there, which, to me is The Walking Dead, right? Like they're dead, just everyone doesn't know it yet. I think the most probable cause or probable effect of this actually is to use options terminology, is this is basically putting a giant wall of call options on the market.
Yeah.
So when you get into the stocks, right? If you, let's say you own, I'll pick a random stock, Johnson and Johnson at, you bought it at 150 and you
Hmm.
sell a call for 190. What that means is, in that call is due on a certain date. Let's just say, December 31st. If on December 31st, the price of Johnson & Johnson is higher than 190, you are forced to sell it at 190
Yeah.
to whoever bought that call option. It could be worth 220. You have to sell it to 190 for 190, right? And the flip side, you get income by selling that call option.
Yeah.
So to get back to real estate,
Covered call. That's a good,
yeah,
I
exactly.
mean,
Covered call. It's very, very
that's a
common.
good, it's a good, the guys that I know that own stock love selling covered calls because it's like they view it as like renting out their stock. It's like, hey, you want to pay me 190 for my Johnson and Johnson stock, come get it. And until then, I'll keep taking the revenue I make on selling those covered calls because you're not going to write a covered call unless you paid a lot less than 190 for the stock. You don't paid 185 for the stock. If I'm okay to make a $5 spread per share, yeah, I'll write the call for 190. Do you see a problem with the covered call psychology and how it relates to real estate?
So we'll look at it from the bank's perspective.
Mm,
What they're doing is they're saying, all right, I've got an apartment complex with a $10 million loan on it. It's currently worth $8 million. And what
okay.
they're not idiots. They're also looking ahead going, hey, wait, we're going to revert to a housing shortage. We still have economic growth. All the forecasts have somewhere between 2 and 5% rent growth in the future years, right? You can debate which one is that, but rent growth. Inflation in general tends to drive up the value and nominal price of hard assets. And so from a bank's perspective, it's kind of like a stock. Well, hey, I own, you know, Creekside apartments for at a basis of 8 million. Or I'm my loan is backed by this asset and my loan's 10 million and it's worth 8. I expect that value to go up over time. I'm going to sell it as soon as it gets to 10
Mm-hmm.
because then I don't take a hit on my balance sheet. I am made whole. I don't give a crap about the operator, the LP
Right.
equity,
No.
any pref equity, like all that stuff. Banks don't care about that. They need to take care of their investors. And so I believe all these deals are going to basically like a call option in that once the market does start to rise, every time a bank says I can get out of this asset and be made whole, they're going to force it to be sold.
Mm-hmm. Mm-hmm.
And so so interestingly enough, I think the market stabilizing and starting to rise is what actually pulls the deals out of the woodwork. Along the way, there's going to be
Mm.
yes, there will be some that's just like, hey, end of the road, you're done. This is being over with.
Can
But
I
I
give you
think
an alternative on that?
overall,
Let me
what's
give you
that?
an alternative perspective, right?
Yeah.
If the market's continuing to rise, right? Like banks, again, they want their money back, but what banks really want to do is they want to make their monthly payment and not lose money, right? Like they don't want their principal to be at risk and they want to keep making their cash flow that they had underwritten the deal to make, right? So if they see a deal that they underwrote at an $8 million loan amount, whatever, I'm going to use my own numbers. I'm trying to match what you were just saying, but like $8 million loan amount, property values 10, they're good because they're covered, right? But if property value drops from 10 to 9 to 8, if property value matches loan amount, I believe the bank would be more likely to start to try and force you to sell, to try and go and do, put you in receivership and bad boys and all that kind of stuff because they want to minimize their losses that they see coming down the pipeline. That's when I back, you and I are both old enough to remember the short sale days back in
Mm-hmm.
2007, 8, 9, and 10. in those days, banks were just trying to get it off their books because they wanted to get their books clean so they could go back out there and start lending money again. They like let's get these losses out, get the losses off, write the check, take a discount, whatever it is, get it off the books. The banks haven't reacted. I don't know if I've seen any short sales in our industry. Period.
We've tried to buy some, and a friend of mine has a sizable portfolio that every asset in it is worth way less than the loan. And I mean, just talking to him,
where's the bank at? Is the bank like pushing them, or are they
It's three different banks on each asset. Right?
Okay.
And I mean, one of them was was working with them. Another one was kind of in the middle, and another one was just like, nope. This is your date. Fix it or lose it. Yeah. At the last minute, all of them offered a solution.
Ah, okay.
So, and I've seen that with multiple people that I know and multiple operators. The banks just seem to be, again, whether it's hopium, optimism, whatever you want to call it, they seem to be just like, we don't want to take the hit now.
There's some factor they're aware of. There's something, and I don't think that they see things getting worse. I think that they, maybe to your point, is that like, we got a better shot of working with this borrower and kicking the can down the road a little bit, and we'll get paid off in 6 months if we give them a little bit of grace, give them a little bit of room, because that maybe they see that the market is going to shift a bit, or they believe that in the next 6 months to a year, versus them getting aggressive and taking the asset back and taking their. I think that they're not going to go and take an asset back if they see the market going up. If they see the market going up, they'd rather let you kick the can. I don't know if that's the right way to look at it.
Well, so I think they let you kick the can until they can be made whole. Then they want out. Yeah.
Right. Yeah. Okay.
So, and then the other potential factor behind this is a slight rule change.
Yeah.
Is the law recently changed that it used to be if a bank had a troubled loan, they had to show it reflected as such on their balance sheet, for the life of the loan. The rules changed this year where if they modify a troubled loan, they only have to show it for 12 months.
Oh.
And then it disappears.
Huh. Poof. Magic. Yeah. Huh.
Magic. So if they just hold on to it. So if they do a modification and then just hang on to it long enough, it doesn't show anymore. So I'm not in the banking sector. Someone who's listening to this who is might be like, dude, you've got it so wrong. But, that's I know that rule change happened, and that could be another incentive.
I'd love to. I'll bring you on as my co-host. If best ever listener, if anybody knows anybody that really knows the mindset, give me the guy at the loss and mitigations department of any bank. Right.
Oh, that'd be a fun interview. Yeah.
I want him on the show, him or her. I don't care if it's big, small, because you know what it is? The mindset's the same on small community bank, little credit union versus some ginormous institution. Give me that person on this program, or somebody who really knows the bank mindset on what they like for loan amounts, and when they get aggressive to take deals back. Bring them on this program. I'll bring Cush back, and he and I'll pick their brains. Right. I'm going to throw a quickie log on the fire. A big controversy here. I got one more controversial question for you, and then I got a fun one, okay, to bring it home with you here. All right, controversial question. Is it possible to be a good real estate educator and a good real estate operator at the same time? Because there are people that are trying to do both. And real estate education is necessary. It's hard to go to college for this thing. So I believe that real estate education is good. And you don't need to, I just don't like real estate educators that make this thing look easier than it should be, or taking selfies next to Ferraris and that kind of stuff. Because that's all smoke and mirrors and bullshit. But it's good. It's okay to pay for education. You and I have both, I know, paid for education in business and in real estate investing, and it's okay. But is it possible to be a good teacher and an operator? A lot of folks try to do both. Is it possible?
It's possible. Very rarely done well, but absolutely, it is possible. And I paid for a 3-day class in the very beginning. Then I paid for a mentor. And I paid less for that than my college degree, and I made way more money than the college degree. Now, I don't regret the college degree. It gave me that engineering foundation and a lot of other good things. But so is it possible? Yes. Does it typically happen? Probably not. Think, if you're looking at this going, okay, I want to pick the right education. person. Because yeah, I mean, I think it's crazy to be like, well, I'm just going to read a book and figure this out on my own. I mean, the stakes
Well,
are
think about that.
serious.
That's what the
Yeah,
alternative is.
yeah,
Like,
that's what the
if you want to
alternative
get
is.
good
Yeah,
at real estate investing, you either work for a firm that invests in real estate and they put you on their payroll and teach you how to do the whole thing, or like you said, go and take somebody's course. Reading a book on the thing is going to get you an introduction, but it's just going to wet your beak.
so I think the differentiator is, so like the class I took back in 2010, it was a guy who, and we did end up doing, like, I'm still in a deal with him today. It was a guy who had done about 800 units, like that was his main focus. And basically people came to him and asked him like, hey, can you start teaching this stuff? He's like, all right, I'll do a course or two. So I think when, you're choosing an education course, person, coach, whatever, you want to make sure that their primary, and it's a little tough to verify, but it's worth doing, that their primary business is doing the thing
Mm.
and not
Teaching.
selling how to do the thing.
Well, I guess that's what I like. You tend to see people lean into one or the other, right? There's a few
Yeah.
friends that you and I both have that are primary operators, and it's like, hey, man, you want to learn? Here you go over here. I have a program like that. It's like, listen, what I do is operate and raise equity for deals. But if you want to learn how to do what I do, here you go. Here's a self-guided thing. A lot of us have that, but then there's also folks out there that have the smoke and mirror thing that they
Yes.
come off like they're operators. They've also got a huge social media following and they operate a bit and their names on things, but really what they are is an education business because they're really not operating. And if you look at
So
the majority of their income is coming from teaching,
yeah, how I approach it is the better the marketing, the worse the deal, and the better the marketing, the worse the program.
Yeah. Yeah.
I mean, it's not always true, but it seems to be a theme.
Mm-hmm.
So, is it possible? Yes. Are there some great operators that have said, hey, you know what? I'm going to do some education. Yes. Just do your, do your due. Just like if you're going to be an LP and you're going to put 50, 100 grand into a deal, it's not passive. You need to do a lot of work up front.
Yeah.
You're going to spend the time and money on someone teaching you, vet them really well. Do your
Might
due
as
diligence.
well.
And with
Yeah.
AI these days, it's not that hard to go figure out what people are up to.
Yeah, ask AI. AI will tell you all about it. Right. Okay, good tip there. All right, bringing it home. I know you on a personal level, and I'm grateful to say that I do. And I know that you, my friend, aside from having this crazy ass hobby of liking to hike up a mountain with skis on your back and then put those skis on and ski down the mountain you just hiked up, right? You're an extremist with regards to your travel and your hobbies and that kind of thing. You also are traveled, right? Like you've been to a lot of fun places, including recently I was talking to you, you went to Antarctica, right?
Yeah, we skied Antarctica. Yeah.
Yeah, skied Antarctica, right? Where is a place that is on your bucket list that you're excited to go that you've not been there yet and why?
Well, that's the first time I've ever been called an extremist, but
I named somebody else in our world that's got that hobby you
no,
got.
yeah, extremist is, yeah. No, I'm just giving you
What
crap
you do is
because
crazier than skydiving. Honestly, I submit that to you that because there's a lot of things that could happen. You know exactly what to do if it did happen, I'm sure. And I don't think you are, I'm sure by far not an irresponsible extremist about it, but you do participate in what I think to be a very extreme sport, extreme hobby, not just skiing.
oh no, that yes.
Not skiing, but I'm talking about like
because
damn the ski lift skiing, right? I don't need
just gotta, hey, yeah, that Andrew guy, he's an extremist. That could
I'll
mean a
just
lot of
walk
things.
there. Right. Yeah.
But so actually, in the near future, I'm in the final planning stages and getting ready to book a ski mountaineering trip to Peru, where I have a goal to climb and ski a mountain over 20,000 feet. And so we're going to go down there. It's the highest tropical mountain range in the world. And the goal is to first ski a peak that's about 16,000. And then the next one's 18,700. And the third one is 20,303. So yeah, that is the next big endeavor is to skied, like you said, skied 7 peaks on the Antarctic Peninsula. And then now I wanted to set some personal elevation records in Peru. So
how many continents have you skied?
not that many. Antarctica, South America, and North America. I haven't made it to the
You haven't
other
done
ones yet.
Europe yet.
No,
Oh,
interestingly
okay.
enough.
I have not. I don't know if you could ski Africa. I'm not sure. Like, I'm certain you could ski Asia. I'm sure there's something in Australia you could ski, but who knows? You probably know. Yeah. Can you ski
You
Australia?
know what? In theory, well, there are ski areas in Australia, and in theory, you could ski the ice cap on Kilimanjaro in Africa. I just don't know if they allow it or not.
Yeah, that'd be. I know I'd be able to hiking Kilimanjaro without skis on my back is on my bucket list. You can come with me, and you can bring the skis, and I'll meet you at the bottom.
All right, there you go.
Yeah. So that's awesome. Real quick, in hiking up that mountain in Peru, are you above the oxygen level to the point where you would need to bring a tank? And have you ever been to that level before where you had to wear a tank and breathe out of a mask?
No, I don't know the exact level that typically people need oxygen. I think the death zone starts at 26,000 feet,
Okay.
but my understanding is at 20,000 feet, the air pressure and amount of oxygen is half what it is at sea level.
So you don't need a mask.
You don't need a mask, but you're really feeling it.
Are you gonna bring? Do you bring like I've been to Denver where they've got like the oxygen in a can kind of thing? Do you bring one of those little one hitters kind of thing to like boost yourself a little bit? No.
You know what? On a multi-day trek, I don't know if that would carrying the weight would be the benefit,
Yeah.
but I actually haven't answered that question yet. We'll
You
see.
just acclimate, I would think. Oh, so
Yeah,
you're
exactly.
yeah. Yeah.
Yeah.
Sorry. This is not a one day thing. This is you would
Oh, heck
be.
no.
It would take multiple days to get to the peak, and then once you're there, and then when you strap skis onto the top of a 20,000 peak, are you down right there in a day, or are you gonna do you work your way down over a couple of days?
You ski back down to base camp. So like on the 20,000 footer, we'd summit and then ski down about 4,000 vertical feet to let's call 16,000, where base camp would be at the foot of the glacier, and
Mhm.
then pack up and start heading down.
Oh, you wouldn't even do it twice. You would just like, that's it. I'm not going to go back up. Like you ski down it.
If that was the only one we were going down for, maybe, but I am probably never going to be in good enough shape to do multiple laps on a 20,000 foot mountain in one day.
Not a day. Maybe camp out. Maybe go take a nap. Right. Go to
Oh, well,
another
actually, yeah, we may do something like that on
Okay.
another one. Yeah.
Okay.
Yeah.
Thank you. I love hearing about your travel ventures, not because I want to do them too, because you're a lunatic and I don't want to do that. But I love looking at your pictures of you doing them, which you sent me quite a few of. Andrew, great having you on the Best Ever CRE show. Best Ever listener, if you want, if you are heavy in the banking industry and you would like for Andrew and I to pick you apart and do a fireside chat with you here to hear the inside of the banking industry mindset, please let me know. Hit me up on social and I'll get you here on the program. Until then, Andrew, how do people that want to hear more about you and join you going to Peru or sell some deals to you, buy some lunch, or hear about you for any other reason they'd like to reach out? How do people get a hold of you?
Vantage Point Acquisitions, vpacq.com, or my only social media that I'm on is LinkedIn. Just go connect with me there.
That's because you don't have a coaching program. That's why you're only on LinkedIn. Yeah. Okay. All right. Thank you so much, Andrew. Thank you for being here for this slightly edgy fireside chat episode. Best Ever listeners, hope you guys enjoyed this too. If you guys enjoyed this program, make sure you tell your podcast carrier that you enjoyed this program by liking this show, by adding it to your feed for your whatever it may be. So you see this program show up every day. Andrew tells me he's one of the cool kids that listens to this program. So why not be a cool kid and listen to this program on a regular basis as well? Until then, guys, thank you for listening today and have a best ever day.